Morning, this is Jerry over at DynamX. Hope you're having a good day today. Did my workout a little different. I took my dogs for a 30-minute walk, and I'm coming to you a little later with my live video this morning. But I wanted to talk to you today about debt. Okay, that's my topic this week. How do you handle your debt? And the big one that I want to talk about is the mortgage. Okay, paying off the mortgage. Should you do it? Should you pay off your mortgage? Now, if you're watching this, you either have a mortgage or you're about to get one, and you're looking at, all right, what do I do with this thing? So here's the deal. When you buy a house, which I don't think you should do, but you're probably going to do it anyways. If you buy a house, you're going to do it with the mortgage. You're probably going to do, anywhere from 3% to 5% down, and you're going to do it on a 30-year note, right? So when you do that, here's what you need to be thinking about. Number one, the home is not an asset. Let me repeat that. The home is not an asset. And this is not to make fun of you for buying a home. This is not to make you wrong. Literally, by definition, like we work with accredited investors. So accredited means you have $1 million net worth, and we're allowed to show you a whole different world of investing once you become accredited. So I'm not allowed, by the SEC, I'm not allowed to include the value of your primary residence in your assets. So when you come to me and say, hey, Jerry, I'm accredited, I can't tell you you're accredited if part of that $1 million net worth includes the value of your primary residence, which means the Securities and Exchange Commission doesn't even consider your home an asset. So you shouldn't either, okay? So if you bought a home anyways, it's a liability. Treat it like that, think of it that way, and here's what I want you to do. All right, so you probably got it on a 30-year mortgage. Yesterday we talked about, doing the debt buyout with your sacred account, and I mentioned your home should not be part of that. Okay, you should not pay the home off early by applying more money to principal. So the short answer is no, you shouldn't pay your home off early. It's a terrible idea. You would never want to do that, just like you would never want to pay off a car early. But here's what you would want to do. I am a proponent of the home equity line of credit. So if you have a home, what I would recommend is that you get a home equity line of credit. And with that home equity line of credit, you're going to refinance your mortgage onto the home equity line of credit. Only certain banks will do this. So only certain banks are going to do this transaction for you. And basically what you're doing is you're getting rid of the traditional mortgage. Here's the deal. When you pay your mortgage, the reason why the bank wants to lend you money for 30 years is they make income on you for 30 years. So you're not applying any money to your principal value on your home, like hardly any at all, probably the first, half to 2/3 of your mortgage amortization. Which means what you're doing is you're just paying the bank interest for 30 years. They're extending and prolonging the event, okay? So here's what I want you to do. If you do a home equity line of credit, you can basically refinance out your entire mortgage on a home equity line of credit. Typically, that is a 10-year note. It is refinanceable, but here's the deal. When you do the home equity line of credit, you're only paying the interest. Okay, it's an interest-only loan. It's typically going to be variable rate, maybe 5-6%. Right now, interest rates are so low that it's a great idea to do. They're probably not going up anytime soon. The way we've damaged our national economy, I don't see that interest rates can ever go high again. But with the HELOC, you're paying just your interest payments. Now you're like, Jerry, shouldn't I pay my home off? No, you shouldn't. And here's the thing. When you do the home equity line of credit on your home, on your mortgage, what you're doing is the same thing that commercial real estate investors do. Okay, think about this. Did you know that when an investor buys a multifamily property, they don't do a conventional mortgage? Okay, they do an adjustable rate mortgage. They're typically going to do a 10-year ARM, adjustable rate. They're paying interest only because they know that property will go up in value and appreciate, and they can sell it for more than the mortgage is worth. Meanwhile, they want to keep their payments low because it's about cash flow. So imagine if you had, just make the math easy, you had a $100,000 home. Okay, that's probably a very low-end single-family home. I realize that, but let's pretend that's your number. Okay, $100,000 home, and you're on an adjustable rate home equity line of credit at 6%. That means that you are paying $6,000 a year in interest. $6,000 a year in interest. Now that's great on your payment. Divide 6,000 by 12. That's what your payment would be. Now here's the deal. You don't have PMI because it's not a mortgage any longer. Okay, your homeowner's insurance is allowed to be different. You don't have money going towards principal. You don't have any money going towards escrow. You make your own insurance payment, so you're able to keep your payment reduced, giving you more free cash flow. That, guys, is why you would never pay off the home early. It makes no financial sense to pay off the home early. And here's the deal, you don't want to try and keep the home forever either. It's no different than a car. Most people are going to move. So if you did buy a home, you're going to move probably in the next 5 to 7 years. When you sell that home, it's going to sell at a higher market value than you bought it for. Again, this does not make it an investment. It makes it a speculation. So don't go like, oh, I'm going to get more money when I sell it. Let me go buy one. Okay, but if you did buy a home, like, it probably will sell for more than you bought it for, which means when you sell it, you just pay off your debt. You pay off the line of credit entirely, and you walk away and you're done. It's like leasing your home. Why would you ever want to own it? So when you're doing your debt buyout with the Sacred account, like we talked about yesterday, you're lining your debts up smallest to largest. The home is not included in that balance for that reason. You're going to do that version, the home equity line of credit. Keep your balance on the line of credit rather than on a mortgage, and keep your interest payments extremely low so that you've got more of that free cash flow, which, by the way, what that does is it allows you to save the free cash flow into your Sacred account, which can be then used to pay down the rest of your debt more rapidly. Okay, so I hope that this video finds you well today. I know that that's a different way of thinking about it. You're probably going to see my friend Kyle post in the comments here anytime today. He's a huge proponent of the home equity line of credit. I am as well. Anyways, thank you guys for watching. If you're watching this video, by the way, I want to post a link in the comments for you really quick. So I'm going to post, it's called sacredaccount.com. Okay, sacredaccount.com. And what this is going to do is it's going to give you access to a landing page full of information about the Sacred account. And you'll see why paying money into your Sacred account is better than paying down principal on your home. Okay, there's like so much more like advantage tax-wise, returns, all of that stuff. All of it's going to be better for you to do. And as you do the home equity line of credit, that is where the free cash flow goes. So click on that link, sacredaccount.com, if you'd like to learn more about that. Again, that is sacredaccount.com. Thank you for watching. Make sure that you do like, share, and subscribe, and I will talk to you soon.